Jeff, in Chapter 6, you talk about utilizing workplace benefits to build financial wellness. I know this is personally a topic that you're pretty passionate about. Why is it so important that employees really understand the benefits available to them, and what can they do to make sure that they're taking advantage of everything that might be offered to them?
Well, as I look at this, my career started 30 years ago when I worked for a bank, selling what was the new 401k plan. And I mention that because that really started a major trend, a major change in how benefits were delivered. Prior to that, most companies offered a defined benefit type pension plan. And with that change that has occurred over the last 30 years, now individuals saving for their retirement need to make choices. It used to be kind of a one-size-fits-all for individuals. You go to work, you have your benefit plan delivered, you retire, there's a benefit plan. Now it's much different. It's much different in that individuals need to understand and they need to engage in their benefits. In fact, the lack of engagement can really hurt an individual, because if an individual chooses not to participate in their employer's retirement savings plan, there simply won't be savings available to fund retirement. So I'm passionate about this because I've gone into thousands of organizations over my career, and I've talked to tens of thousands of employees, and a common theme I hear from individuals is, I wish I would have started earlier. I wish I would have saved more in my employer's plan. And in fact, for individuals that invest regularly in their employer plan, they will find that in retirement it may be their biggest asset. And so it's really important for employees, as they're building the foundation for financial wellness, to fully participate in the benefits their employer offers.
I really like this chapter. I like all of them, but this one, I think, really pulls together a lot of what we've talked about. And what's really key is you look at building long-term financial wellness. For many of you, if your employer offers health benefits and some type of retirement savings benefit, you have a combination for really building a solid foundation over a period of years to really help you build financial wellness. Now, let me take you back 30 years when I first came into the benefits industry. 30 years ago, most employers offered kind of a what I call one-size-fits-all benefits plan. You went to work, you became eligible for benefits typically 6 months after you started, or maybe a year, and everybody received the same health insurance plan and the same pension plan. And for many people, the pension plan did not require any contribution. And if you stayed with the employer for a number of years and retired, you had health benefits for life and you had a pension check delivered to your home every month. Well, that has changed for most of us. And the reason it changed, frankly, is because those health benefits became so expensive that employers just could not continue providing those benefits in the same way. So it's really cost that has driven the change in benefits. So step one is to really step back and understand the benefits your employer offers, because not making appropriate decisions, or any decision at all, can result in you not having coverage for essential benefits. And let me say this, and I think this is key, is one of the best methods for building financial wellness in your life is to utilize the benefits your employer provides appropriately. And so I'm going to spend our time in Chapter 6 discussing two of the key benefits and some other benefits that complement those benefits. It's your health insurance benefit and your retirement savings benefit. And when you look at figure 6-1 in the book, this shows you the cost challenge when it comes to health benefits. And it shows you with the bottom two lines the average wage increases and the average inflation rate. The top two lines represent the real cost challenge. The top two lines represent the average annual health insurance cost increases and the employee cost share to pay for those cost increases. And you can see that the gap between the bottom two lines and the top two lines is significant. And that is what is driving all of the change that we see in health benefits. Think about it. If you've been in the workforce for a few years, virtually every year there are major changes to your health insurance plan. I work for a major health insurance carrier in the Midwest, and I often hear from employees, gee, the health insurer comes in, and every year the plans become less in terms of what is covered. Deductibles go up, co-insurance goes up, the prescription drug benefit, the co-payments go up, but the employee is asked to pay more. And I always like to just kind of share the why. And I think that figure 6-1 gives you a really good idea of what is going on. So what's your takeaway? The takeaway is that the decisions you make really matter when it comes to health insurance. And if your employer offers more than one plan, and many employers do, you'll have to make some trade-offs in terms of what is the best coverage for you and your family, and how much do you want to pay on one plan versus another. And so the real key is to look at your need for health insurance and to balance that with how much you are required to pay. And what you will sometimes find is that if you have relatively good health, that it may make sense to take the plan with the higher deductibles and the higher co-insurance amount, because you will pay less in your premium share. So it really pays to be diligent as you look at the best health plan option. Now, something I want to say too that complements your health insurance plan are two things. Number one, flexible spending accounts. And if you choose a health savings type account, it would be a health savings funding account. So for most people, you are offered a flexible spending account. And if you're eligible to participate, it can represent a great way to save on out-of-pocket health insurance costs. Unfortunately, fewer than 25% of eligible employees participate in their company-sponsored flexible spending account. And the reason for that is that when you decide how much to put in that account, you have to use it or lose it during the plan year. But if you just sit down and kind of conservatively think of health expenses that you utilize, you will find that in most cases you can put aside money and you save on your taxes, and it results in a nice way to pay for additional health insurance costs. When you look at the appendix in Chapter 6, I've listed some of the covered expenses that you can pay from your flexible spending account, and you'll see that many of those are items that aren't typically covered inside of your health insurance plan. So I think with a little work for most of you, probably 5-10 minutes is all it'll take, you'll be able to decide on a dollar amount that you can put into that plan to use for qualified expenses. For those of you that go into a health savings account, and those are being offered more and more by employers. By law, you can't fund both a health savings account and a flexible spending account. But the good news is that if you fund your health savings account, you can actually fund it with more dollars than you can with a flexible spending account, and the use it or lose it rule does not apply. So it's kind of cool. You have additional financial flexibility, and you can let the dollars in your health savings account roll over year after year. Another thing to look at involves your company's wellness program or any wellness benefits offered by your health insurance carrier. Both companies and insurance carriers recognize that due to rising healthcare costs, if individuals can make better health choices and stay healthier, it's good for the health insurer, it's good for the business, and most importantly, it's good for you because after all, who doesn't want to feel better? And so I really make it a point to say to individuals, take a good look at what is available, because you'll find often by participating in the wellness benefit, if there is one, that you can save a substantial number of dollars, perhaps on your health insurance, or you can basically receive additional compensation that can help you to pay your share of health insurance. So there's never been a better time to really take a look at any programs offered by either your employer or a health insurance carrier to improve your health. Now I want to transition to retirement savings program and provide you some additional thoughts in this particular area. When you look at figure 6-2 in the book, this shows you the percentage of savings of workers in retirement savings plans. And the idea is to be as far over to the right as possible, to accumulate as much as possible. And no matter where you are in the workforce, if you're just starting out, great news, you have decades to save and invest. Or if you're fewer than 5 years from retirement, there's never been a better time to invest, because when you think about it, when it comes to retirement, the main source of income that most of us will have is what we accumulate. And for most individuals who have invested in their company retirement savings program, they will find at retirement that the largest financial asset they have is what is in that account. So very important decision to participate, and to participate as fully as possible. Why? You get a tax deduction. You save on federal and state taxes. The money you put into that plan grows tax-free in the account. It's only taxed when you take it out, hopefully in your retirement years, when you're at a lower tax bracket. Most companies offer some type of a match. Know what that match is and make sure that you're funding to take full advantage of any company matching contribution. In addition, really commit to increasing your contribution at least annually. Take it up by a percentage or 2 percentage points. Some employers allow employees or provide a mechanism which is called auto escalation, where your contribution goes up by a set amount. It can either be a percentage or a dollar amount. Look into that, because there's nothing easier than having something happen automatically. And so look at that. And one of the things I do is, personally, I look at my review cycle, which is annually, and every company has a different cycle. But a great way to increase your ongoing investment is whenever you receive a pay increase or a bonus. Devote a portion of that to your retirement savings plan. It's a real easy way to do it, and the great news is you won't miss that money because it either represents a raise or a bonus. Also, you are responsible for making the investment choices in your company savings plan, and that's why in a previous chapter I discussed asset allocation and the importance of it. And asset allocation, whenever you're investing in financial assets, and typically what's offered in your employer-sponsored retirement savings plan, involves stock or bond mutual funds. And so it's important, as I indicated in a previous chapter, to remember, put your eggs in multiple baskets. So that's critical. And the other thing that I'm seeing in a number of plans are what are called target date funds. And if your retirement savings plan has a target date fund, it's something to consider, because what that fund does is it typically will adjust its asset allocation around your planned retirement date. So if you plan to retire in 20 years, there might be a fund that plans on adjusting its assets each year to kind of target that retirement date. So the bottom line is that know what your investments are, choose your asset allocation, and stick with it. And then each year, re-examine your asset allocation and also consider what we call rebalancing your assets. And what I mean by that is if you decide that you want, say, 60% to be invested in stocks and stock mutual funds and 40% in fixed income or bonds, each year you look at it and you look at your percentage of your investment that is in stocks and bonds, and you rebalance it so that it gets to that 60-40 level, because financial markets go up and they go down. And I don't want you to get concerned about that because you have your asset allocation. But once a year, you'll have that opportunity to make an adjustment to your asset allocation. Maybe you want to move up your stock allocation to 70% and bonds to 30%. And maybe you want to rebalance what you have in your account to reflect that 70-30. The key is typically annually, you'll want to take a look at that, because you don't want to get caught up in the ups and downs of the financial markets. I see a lot of people make mistakes with that. And typically what happens is when they try to assume what the markets are going to do, they do precisely the wrong thing at the wrong time. And so that's why asset allocation is so important. It forces a discipline on you, because understand that when you put money into a retirement savings program, you will not need that money in most cases for years, if not decades. And so the inevitable ups and downs of the financial market can work to your advantage over time, because you set your asset allocation and you have, through your payroll deductions, a consistent amount of funding going into the accounts, and you use what we call dollar cost averaging for your new funds. So if the market's really down, guess what? You get to buy more. Stocks and bonds are on sale. Conversely, if the market's up, you buy less. And that's how it works. None of these strategies will guarantee a return, but what they do is they, again, force a discipline that tends to work very well and gives you the best opportunity over a period of years and over a period of what we call market cycles, which tend to last for years, to have the best result. And so if you apply those techniques, what you will find is over a period of years that your retirement savings program will become significant. But it requires your participation. It requires some work on your end. And once you do your work and once you have your asset allocation, you can sit back, continue doing your job, continue funding the account, and hopefully watching that account grow over time.